Yo guys, Leggy here and welcome to a new video where we're going to be doing an update on my portfolio on Trading212. So it's been a really interesting month really. So I explained a video yesterday basically saying why I think that the S&P 500 will see a time of volatility within the next year. And this is mostly down to what I said was Trump's tariffs. But this is actually a reason why we've seen a rebound in the past few days. There's a report basically saying that not all of his imposed tariffs will actually come into play on the 2nd of April, which has, as I said, caused this jump in the stock market. So obviously news changes all the time. Trump's a very erratic president, so this could change at any time, especially with just news like he announced yesterday with the Venezuelan tariffs. It just shows that news like this can change. Now, this makes me say that we're not out of the woods yet, and I would definitely still wait until the 2nd of April when tariffs come into play, because we'll have a lot more information on what comes into play, what he actually is giving relief on. But obviously, the stock market works in a speculative way. Obviously, political tension is very high as well, with Donald Trump actually having WhatsApp group texts released as well. So obviously advancements in that could affect the stock market at any time as well. Now let's actually have a look at my portfolio. So we have actually quite cash heavy, and this is because I took profit in November. I explained this in our previous video, but essentially we had about 16.5k in stocks around about November. I decided to take profit. That was a profit of around about 2.5k, and this has led us to actually re-enter the market. So as I said, a correction happened earlier this month, which means that the S&P 500 dropped by about 10%. This meant that I stuck about £1.5 grand in with the intention to re-enter the stock market and start a plan again. So if we look at our cash ISA, we've got £13,590 and 31 pence, and I will move enough money every month to cover £15 a day I'm investing in my stock size, which I'll get into in a second. But that is how I'm playing it out at the moment. You're probably wondering, why have I got the money invested in cash ISA and not just literally essentially invested in the stocks ISA? Now, the cash ISA has extra protections to cash if anything went wrong. This is why I'm doing it. So essentially the difference between it is that the stocks ISA invests your money in cash and also QMMFs, which has a, albeit very small risk, but still a risk. Whereas the cash ISA just invests my money into cash. That's why that's why I've got my money in the cash ISA and just moving over as and when. Now, this does actually mean that there's a slight difference in the interest rate on the accounts, with at this moment cash ISA returning 4.5% and the stocks ISA giving 4.6% on cash held. So I am losing 0.1% there, but it's just not a risk I want to take for that 0.1%. Although I do have enough cash in our stocks ISA to take us to £15 a day invested until the rest of this month. Now, as discussed last video, we've got 3 pies. So we've got the VUSA, which is actually 2.03% up, and this is a rebound I explained earlier. What I did, I decided to stick about £1 grand in after the 10% drop, just because obviously I also explained this in my video yesterday, but you see about 3/4 of corrections end up recovering, and only 1/4 end up into bear markets. So although I've got enough cash that I'm prepared for a bear market if that does occur, I didn't want to miss out on the opportunity of a 10% correction. Hence, put in about 1,500 into our long-term pie and our VUSA pie. Now, in our long-term pie, as discussed previously as well, we've got basically Berkshire Hathaway. This is because they're very good at creating income and reinvesting this income in well-valued stocks, but they're actually quite cash heavy at the moment, which hopefully means they're a good investment in a recession. Also, we've got reality income. Now, because of Trump's tariffs, it doesn't look like rates are going to be cut anytime soon, because of slowed economic growth, which could occur. But what I do want to do is take advantage of these lower prices for your reality income, and when the day comes, whether it's in 5-10 years, of rates actually being cut, seeing the gains there. I mean, we're getting monthly dividends, so we are getting a gain at the moment, but that is a very long-term play and almost just a play for when interest rates get lowered. Now we've got the FTSE All World in this pie, and if you guys didn't watch the last video, basically I talked that this one was to get us more diversification to the world, but a massive problem is that it's very weighted American heavy. This is why we've started going into our rest of the world pie, which is essentially everything that's not America, and I'll put up the list here. Now in the rest of the world pie, we have got everything is up in the green, which is good, apart from China. Now, China had a real boost when people were uncertain about the American market, but it seems like now the dust is settled a little bit. People know what they're expecting a bit more with the tariff situation. That, as I said, America has made a recovery, whereas China has decreased a little bit. But as I said, we've hardly invested anything in the rest of the world pie with £55, just investing £5 a day in that one. In the long term pie, we're also investing £5 a day. That one's up at 1.95%. Now, it is worth noting that historically, basically our long term pie and our rest of the world pie wouldn't outperform the VUSA pie. But who's to say what the world looks like in 30 years? We seem to be in a time where a lot is changing, a lot of change will occur, and although the long term and rest of the world pie may not give us the same returns as the VUSA pie, if we were just to invest everything in it, what it does do, it gives us some stability, just in case anything does go array with America like we have seen in the last few months, and just covers us from a few scenarios happening. Now, like I said, our plan is to dollar cost average, and this is essentially spreading out your investment so you get the highs and lows of a price, and this means that yes, you may not get as much profit as if you were to lump sum when the market dropped, but what it does do, it protects you from market movements a little bit, because your price will average out. So obviously we've still got a large amount of cash. Like I said, I'm going to be investing £15 daily, moving over from our cash ISA back into our stocks ISA. I've done the calculations, and this takes us about 2.5 years to invest £15 a day. Whether I'll speed it up, if there's any good buying opportunities and any more drops, and I lump sum, that's yet to be seen. I'll just have to decide with whatever happens in the market. But for now, what I can confirm is that we are going to be investing £15 a day, £5 in each of those pies, and we will just carry on with that. But yeah guys, I hope you guys did enjoy that video. Please leave a like and subscribe, and I hope you enjoyed, and yeah, peace.